Ray Dalio has been warning us of a coming steep market crash, and experts like Ray are now pinpointing exactly when and how to know that this crash will occur. But we've all heard the stories about people like Michael Burry making millions off the stock market during a crash. This incident was so famous that a movie was made about it titled The Big Short. And Michael Burry's recent Twitter post is something to see when it talks about crashes. But not only Michael Burry, but you can make impressive profits if you know how to use lucrative strategies. But first, when did Dalio and Burry say this mother of all crashes will occur? The bad news is that no one knows. We just know that another big market crash will occur someday. But I can share with you how to know exactly when the stock market crash will occur. First, it's a steep market crash, short-term pullback. Hi, wealth friends. This is Lynn, and welcome back. If you're not familiar with me, I worked for years with Fortune 500 CEOs and financial consulting teams to help companies determine where they were making money. Now I use this knowledge to analyze and invest in the stock market. Over the years, I've discovered a clear signal pinpointing that a crash is going to keep on going, down, down, and more down, like those of 2001, 2008, and how to recognize a shorter, steep pullback like that of 2020. Today, you'll find that despite the current bear market, if this crash of no return has begun, or if it's possible that this market could revive and turn back upward for the long term. But first, if you could give this video a thumbs up in return for my efforts bringing this information to you, it would be greatly appreciated. And while you're at it, subscribe. So let's go and discover if the stock market has already reached that point of no return, and then what you can do next to reap big profit. But first, remember that this video is not financial advice, but for entertainment only. Now let's talk about how to spot a stock market crash. First, a market downturn is signaled through 2 consecutive daily charting candles with lower lows and lower highs. In looking at this chart of the S&P 500 Index Fund SPY, or known as the Spider Fund, there's been plenty of those daily lower lows and lower highs of late, occurring in 2022. Next, we look for the signal that the market has floundered into a bear market. This happens when prices have fallen 20% or more for 2 months or more. And unfortunately, bear markets can also accompany economic downturns, such as Dalio's warned recession. But receding into a bear market doesn't yet signal that a long-term crash has begun. We can see on this chart of the SPY S&P 500 ETF that this index entered a bear market in June of this year. The recent high of $478 was reached on January 4th, 2022, and the recent low was reached on June 17th of $365. This was a 24% pullback. But you ask, can we still recover this year from the bear market downturn? So let's find out. A market crash can be first led by a downturn in the S&P 500 index or the Nasdaq's faster moving growth stocks. And this year, the Nasdaq has pulled back much lower, as you can see by the blue line on this chart. I tend to watch both the S&P 500 index by following the related ETF SPY and the Nasdaq through its related ETF QQQ. But today we're talking about a potential general overall market crash, so we will continue to focus on the S&P 500. How do you spot this market crash? Next, I'll show you how history has shown exactly how to do just that. A market crash is easy to spot if you have your broker's charting program set up with the following exponential moving averages: a 25-day, a 50-day, and a 100-day moving average. Plus, your chart needs to be displaying weekly candlesticks. This means that each candlestick is reflecting 1 week's price movement for either the SPY or QQQ ETFs. Every single time you'll find that a longer term market crash that's going to keep on dropping flashes when the 25-day EMA moving average crosses over the 50 and 100-day moving averages. Remember that weekly candlesticks reflect investors' strong market sentiment. So they are the candlestick timelines to follow. Let's take a look at the exponential moving average crossovers for 2000, 2008, and 2020. So I could show you when each crash flashed, and then we could compare this to this year's movements in 2022. You can see these EMA crossovers occur during 2001 and 2008, but not in 2020. This meant that the 2020 crash would only be a shorter term market correction. And sure enough, it lasted for only about 1 month. Now that you know how to spot a deeper and longer term stock market crash, exactly how do you profit from this crash? One of the easiest ways to profit from a crash is by trading an inverse ETF such as the SDS, which is the ultra short or inverse bear or 2x of the SPY, or the QID, which is the 2x inverse or short bear for the QQQ. You'll want to enter an inverse ETF when it has a large average trading volume so you can quickly trade in and out of the fund. You can track the volume visually on the chart and through the ETF's Yahoo Finance profile. You can see that here in looking at the green and red volume bars showing below on the 1-year chart for the SDS. Just be careful with these ETFs though, because they can drop as quickly as they rise. Currently, we have a significant opportunity to profit from an inverse ETF trade in 2008. At the start of this last major stock market crash, SDS was $1,048 per share and increased to $1,517 per share in 1 month. Obviously, the initial cost of $1,048 would limit the number of shares the average investor could afford to buy. Currently, SDS is around $50 per share, which is a much more doable price. Or if you want to take a more conservative approach, you can trade the SH Pro Shares Short S&P 500 ETF, which is currently in the $16 range and is a direct inverse for the S&P 500. You can see here the chart for the ProShares Short SH ETF compared to the SPY ETF shown as the blue line. As the SH moves up, the SPY moves down. I always like to be in an inverse ETF trade when the stock market is pulling back and the VIX is elevated above 20. The VIX signals investors fear, and the higher that the VIX number is, the better. This year-to-date chart of the VIX with daily candlesticks shows that on the low side, the VIX only went down to $19 per share, and on the high side, as high as $35. When watching an ETF for a long-term investment or for a market crash, I always set up my charting with Heikin-Ashi candlesticks. This type of charting candlestick makes it much easier to spot market trends. This type of candlestick uses a fascinating arithmetic scheme, and I made an entire video on Heikin-Ashi candlesticks that I will link at the end of this video, and which is also linked in the description below. So when do you get out of a stock market crash? Inverse ETF? The timing of exactly when you jump out of an inverse trade is a personal decision regarding how long you want to hang on for more profit, but risk a potential market reversal. Once you've entered an inverse ETF trade, it's best to switch to watching its chart as a daily candlestick view or even the 4-hour candlestick view, as the major uptrends can occur in shorter spurts of often 8 to 12 days. This means you'll want to make a decision at the time of entering a trade at what price or type of price movement you plan to exit the trade, both on the upside or downside. As the stock market has historically, over its entire history, increased in value over time, I do like to get back into my wide market ETFs such as SPY, VOO, QQQ, or XLK once the market corrects. But you may ask how to determine a market bottom for the S&P 500. No one has figured that one out yet, but you can look at historic pullback percentages to determine points at which to re-enter or add to your positions. Here are points at which the market previously turned back up, and you can potentially allocate funds to re-enter at each point. In 2020, the stock market pulled back 36%, but that wasn't a long-term market correction, so we won't use that percentage. In the 2001 stock market pullback, the stock market pulled back 46%, and in the most severe modern-day crash, the stock market pulled back 56% from the most recent high. The S&P 500 ETF SPY reached a high of $479 per share on January 4th of 2022. A 46% drop would put the price at $258 per share. A 56% drop would put the price at $210 per share. These would all be potential re-entry points to consider. And if you want to really be conservative, reserve funds to re-enter at a 79% drop, which would mean a price of $100 per share. I am making updated videos for each of these ETFs for 2022 regarding how to spot a crash for each and how to determine a potential safe re-entry point based on historic pullbacks. So watch out for each. I'd love to hear your comments. Now go here to review our other stock market crash videos.